Welcome back to the channel. Today we'll be looking at two live examples of a options straddle. We'll talk about the positives and negatives of this strategy, and in a few weeks I'll do a update of how these played out. This is not a good strategy for the play it safe type investor, since it is possible that you lose your entire investment if the stock does not make a big move up or down before expiration. Your losses are, however, capped at the cost of the premium. There are a lot of videos on YouTube explaining what the option straddle is, so I'll just briefly sum it up by saying the long option straddle is when you buy a call option and a put option with the same strike price and same expiration date, with the hope of the stock making a big enough move in either direction to offset the cost of both options. Everything beyond that becomes your profit. So you really don't care which direction the stock moves, you just need it to move more than the market makers have priced into the options. So let's look at the first example, which I did on GRAB. I chose GRAB because it's new to the market, and they just merged with a blank check company and are getting a lot of attention. So I expect high volatility. You can see November 11th, it was at $17 a share. Since then, it's dropped 56%, $7.11 a share. Purchased these on 12/6. So 1 week ago, the stock was close to $9 a share. I got the $9 call. I picked up the $9 call for $120, expiration January 21st. So we have 6 weeks to expiration. The current value, it has dropped to 0.35, down $85 on the call side. On the $9 put, the purchase price was $185. Current value is at $235. So we are up $53 on the put. So even though the stock has dropped $2, overall my cost of the two premiums is $305, and the current value of both is $273. So after 1 week, we're down $32. You can play this different ways. You can hold till expiration, or you could close the put if you get your investment of $305 back and have a free $9 call with a lot of time left. Or you can let it run till expiration. Two big negatives with this strategy is you have to overcome time decay or fade on both the call and the put, and you have to overcome the premium of the failing contract. The big positives are unlimited upside on the call option, and the only limit on the put is the value of the stock times 100. In this case, GRAB can only go down from 711 to 0. Best case scenario, in my opinion, is the put goes up enough to pay both premiums. You close that and then have a free call option with unlimited upside potential if you have a lot of time left. If it were close to expiration, I'd either close both or close the put just before expiration. The second that I did was on Sofi. I chose this one because I like the way the stock moves. You can see in the past year it's gone from $7 up 130% to $25.78, down to $15, up to $23, down to $13.75, and back up to $23.29, back down to $15. So it's get consistent swings. I also got these options on 12/6. So about a week ago, when the price was around $15.50, the expiration on these is February 18th, 2022. So 2 months away. The strike is $15. Call option costs $2.90. And the current value is at $2.23 for a loss of $67. The put cost $2.15. Current price is $2.18 for a small gain of $3. So if I did go up to $17 last week, causing the call option to go to $3.60, but then came right back down. The total cost of the trade is $5.05. Current value after a week of little movement is $4.41 with a loss of $64. We'll do a follow-up and show the results of these trades. Maybe it will help someone else decide if option straddle is something you may want to consider or to leave it alone. A pretty helpful website is the optionsprofitcalculator.com. You can, before you even make your trade, you can go to the advanced settings, hit straddle. There's a little explanation of what that is. You can put in the company name, search. It will populate the current price. So you can go right here and select the call, mid price, and go here, select the same date, select the put and the same price, and calculate and widen the range that it's going to show you. You can say from $10, $30. So it would show you how much movement you have to have. So for example, on this trade, if it stayed at 15, you would lose your $124 that you paid for those. If it went to $16.50 by expiration, you would get $26. So long as it went down to $13.50. So that factors in the cost of your put and your call options and shows you what your profit would be. Of course, this is not exact because your implied volatility is going to change along with your other Greeks, but this website will give you a ballpark idea. So pretty neat tool. So thanks for watching. We'll check back for the updates on this, and we'll see you next time.